Wondering why you didn't pass the real estate exam? Have you failed or totally procrastinated because you think you can't pass it? Well, I'm here to show you that you freaking can. I'm Janice of Pass with Janice, and today I'm going to explain to you PMI so that you understand it and don't just have to commit it to memory for the exam. Let's start by talking about what is PMI. Well, PMI stands for private mortgage insurance. When we hear the word private, I want you to think about people, businesses, civilians, civilian to civilian versus government or public. When you hear government or public, it's going to be a law or the government entity or government agency. So right away off the bat, when you hear PMI, private mortgage insurance, I want you to think about a private company, maybe a for-profit company, because that's what it is. So PMI, first of all, let's talk about the history. How did it start? Well, it was in place before the Depression and then it disappeared. But we're going to start with modern history. And this is not something you need for the exam, but it's something that I want so you understand what PMI is. Back in 1907, MGIC, which is the Mortgage Guarantee Insurance Company, was founded to make things easier for borrowers because getting federal government to insure loans had been really tricky and cumbersome, especially since everything blew up in the Great Depression. The purpose of PMI is to make it easier for lenders to borrow money while decreasing the risk. And here's what it means in a simple way so that you understand. Banks are conservative. Banks are typically comfortable with loaning an 80 LTV, which means 80% of the value of the property. The reason why they're comfortable with 80% is because they want a cushion, a margin of error in case the borrower defaults. So let's say somebody buys a house and it's a $100,000 house and they borrow $95,000, which is way more than banks are comfortable with. Things are going along fine for a few months, and then all of a sudden they lose their job and they come on to financial hard times and they stop paying their mortgage. Well, what happens is the lender has to, first of all, miss a few payments, and then they have to file for foreclosure. And foreclosure is expensive. There are legal fees, there are filing fees, plus all the interest and penalties that are accruing while the borrower is not making payments. So in the meantime, this $95,000 balance on a mortgage is going up, and it might even go up higher than the $100,000 value of the property. It can happen that fast. And so the bank knows that if they force a foreclosure sale and the debt is now more than the value of the property, they might not get paid back. And they're not comfortable with that. They don't want to loan $95,000 on a $100,000 purchase price because they're concerned about that cushion. They want to make sure that it's thick enough so that if they have to file for foreclosure and the balance goes up, they're going to be pretty confident that they're going to be able to get their money back. Now, things can happen. Values of houses can go down, of course. That absolutely happens. They can also go up. But where the banks land, where they're comfortable, because of all the analysis that they've done, which is beyond the scope of this course, is 80%. Based on all the studies, all the statistics, all the whatever, that's where they landed. Meaning, if somebody wants to buy a $100,000 house, the bank is comfortable statistically that if they loan $80,000 on that, and of course the borrower is qualified, that even if the borrower defaults, their chance of getting their money back at a foreclosure sale is good enough that they're comfortable loaning $80,000 on a $100,000 purchase price, which is an 80 LTV. But anything above that makes them have the shakes. They start to get uncomfortable. And they're like, okay, well, this borrower looks good now, but they could fall down a flight of stairs and break their leg and then not be in work for a while. Or that gambling problem they have could resurface. And the next thing you know, they're not paying their mortgage anymore. So banks aren't comfortable with that. The only way that they're going to loan you more than 80% of the value of the property is if they have some type of insurance. And that's where PMI comes in. A PMI company is a private company. It's like a for-profit insurance company. And what that PMI company does is they say to the lender, listen, I know this borrower wants to borrow 90%. They want to borrow $90,000 on a $100,000 sales price. And I know that you as a bank are only comfortable loaning them 80. but you've pre-qualified them and they can handle the payment on a $90,000 loan. We're not worried about the borrower. We're just worried about the value of the house, that there's not enough of a cushion in case something turns bad. So what we're going to do as a private mortgage insurance company is we're going to issue an insurance policy that covers just that 10% between the 90 that you're going to loan them and the 80 that you're comfortable with. So on a $100,000 purchase price, you're comfortable loaning them $80,000, but they want 90,000. It's that $10,000 difference that's going to give you the shakes. We're going to insure that. Meaning, if the borrower defaults and you go to foreclosure and you only get $80,000 back, but you're owed 90, we'll pay it. We'll pay it because that's what the borrower is getting private mortgage insurance for. Now they're going to pay us every single month and we're going to make money because we're an insurance company and that's what we do. But we're going to write that insurance policy for you. Now, we have to look at the borrower's application and we have to approve them also, but we're going to pretty much use the same criteria as you, the lender, does. So it's pretty much guaranteed that if they get approved for the mortgage, they're going to get approved for the PMI, but we're going to charge them and we're going to add that onto their payment every single month. You're going to collect it along with their payment, and then you're going to send it to us. And we're going to keep that money, and we're getting it from lots and lots of borrowers all over the country. And so if we have to pay out a claim here or there, that's okay because we're collecting a whole lot of premiums, just like any old insurance company does. Now, don't forget that when a borrower pays PMI, there are a few things that they need to consider. The first one is that they have to qualify. They have to qualify because that extra PMI payment is going to be added to their debt to income ratio. Debt to income ratio is affected by that monthly PMI payment. Plus, it's actually costing them extra money out of pocket that they're spending every single month and they're never getting back. And it is not tax deductible anymore in the United States as of the date of this video, which is 2026. Now, lots of borrowers decide that they want to put down less than 20% and they're willing to accept the extra payment of PMI, but it doesn't last forever. And that's really important to know. When the borrower gets to 20% equity, meaning they've paid down the loan so that the balance is now $80,000 based on that $100,000 sales price, they can request to have it removed. But there's a law that went into effect in 1999 to protect borrowers because borrowers were complaining and suing that the lender was supposed to remove the PMI and they never did. So borrowers, lots of them, had been paying PMI long after they were required to pay it. And now the law says that once the borrower hits 22% equity, meaning they owe 78% of the original appraised value, which is $78,000 in this case, the lender has to automatically remove the PMI. This is important to remember the difference between PMI and MI, which we talk about when we discuss FHA loans. MI is mortgage insurance, and that is government backed, opposed to PMI, which is privately backed by a for-profit insurance company. The law requires that PMI be removed when the borrower gets to 22% equity, but MI lasts forever. It lasts for the life of the loan. Even when the borrower gets down to 50% equity, it's still there till the very last payment or until they sell the property or refinance the mortgage. So PMI can be a really useful tool for your borrowers, and the mortgage lender is going to be the one that really helps them calculate out the amount that it will cost and their options about whether they want to put more down or go into a special kind of loan that avoids PMI by increasing the interest rate and building it into the loan. But now that you have a basic understanding of what PMI is, let's talk about what you need for the test and go over a few practice questions. PMI stands for Private Mortgage Insurance, and it allows lenders to lend borrowers higher than 80% of the value of the property. For lending purposes, loan to value is determined on either the sales price or the appraised value, whichever is lower. And the lender is doing that to protect themselves. For example, if a house appraises at $100,000, but the sales price is $105,000, the lender is not going to loan 80% of $105,000. They're going to loan 80% of 100 because the appraisal is done for the lender to assure them what it could probably get at a reasonable sale if the lender needs to foreclose. So they're going to go with that lower number, rather be safe than sorry, because lenders are conservative. So here's what you need to know for the exam. PMI stands for private mortgage insurance, meaning it's a private company, a for-profit company that is offering this insurance to the borrower at the borrower's expense. PMI insures the lender, not the borrower, and insures the lender for the difference in LTV, meaning if the lender loans $85,000 instead of 80 on a $100,000 loan, it's just insuring them on that extra $5,000. PMI legally drops automatically when the borrower reaches 22% equity based on the original appraised value. Meaning, if they purchased a property and the appraised value was $100,000, once the borrower's loan balance gets to $78,000, by law, the lender must remove the PMI. However, if the borrower qualifies, usually by having on-time payments for at least 2 years, and they get an appraisal and the property value has gone up, once they reach 20% equity, they can request to have it removed. There's your explanation for PMI, and it'll help you pass the real estate exam. But let's jump in and do 2 practice questions to see if you really understand it. Number 1, ideally, lenders prefer a down payment of at least what? This is a simple memorization question, and the answer is 20%. Remember, we talked about an 80 LTV, which means if the lender is loaning them 80%, the balance of the 100%, which is 20%, is how much the down payment is. So ideally, lenders prefer a down payment of at least 20%. Number 2, when using LTV to calculate the loan amount the lender uses, and remember, LTV stands for loan to value, are they going to use the appraised value or price, whichever is higher, 90% of the appraised value, 80% of the sales price or less, price or appraised value, whichever is less? Let's think about this one. 90% of the appraised value. Well, we already said that lenders like to loan 80%. So that's not the answer. So what's this one? 80% of the sales price or less. 80% of the sales price. Well, it's not the sales price, because remember we said that the lenders are conservative. You could set your sales price at anything. You could set it at $1 million, but that house can be worth 50 grand. So the lender's not going to loan 80% of the sales price. The sales price is made up. They care about what the appraiser says. So it's definitely not this. Now let's see which one of these. The appraised value or price, whichever is higher. If the appraised value was $100,000 and the sales price was $500,000, do you think that the lender is going to say, oh, well, we'll loan you 80% of $500,000 because that's the sales price? No, because that would mean they're loaning you $400,000 and the house is only worth $100,000. So that absolutely doesn't make any sense whatsoever. The one that's the answer is the price or appraised value, whichever is less, because if the appraised value is $100,000 and the sales price is $500,000, they're limiting it to 80% of that appraised value, because what they're trying to do is protect their interest so that if they need to foreclose on the property, they're going to get their money back. So the answer here is always going to be price or appraised value, whichever is less. Now that you understand PMI, you can get it right on the test. And if you don't get it and you have any questions, just pop them right here in the comments and I'll jump in and answer for you. And don't forget that I have tons of resources for you. I do videos on TikTok. I have a Facebook group, Beat the Real Estate Exam. And if you're totally stuck on the real estate exam, you're failing and you don't know why, it's because you're studying wrong. It is not just about concept and memorization. There are 4 pillars that you need to pass the real estate exam. And if one of your pillars is weak, like mindset or strategy, you could be studying wrong, and that's why you're failing. There's nothing wrong with you. You're not broken. So grab my free quiz, figure out what your weakest pillar is, get your customized study plan, and beat this real estate exam once and for all. And remember, if you like this video, hit the like button and the subscribe button so you don't miss a single video.